You've been contributing to your 401k for 20, maybe 30 years. Every paycheck, money comes out before you even see it, drops into a fund your employer picked, and you watch the balance grow. You probably feel pretty good about that. You're doing the responsible thing. You're diversified. You're in a target date fund that automatically adjusts as you get closer to retirement. What nobody talks about is that 3 companies own the funds inside your 401k, own major stakes in the companies those funds invest in, and quietly collect fees on every single dollar you've saved. I spent a genuinely uncomfortable amount of time digging through SEC filings and DOL reports for this one, and what I found is a fee structure so layered that the government's own auditors admitted participants can't figure out what they're actually paying. So if you've ever looked at your 401k statement and thought, this seems fine, you might want to keep watching. BlackRock, Vanguard, and State Street. Those 3 names might not mean much to you, but they manage a combined $31.7 trillion. That's more than the entire GDP of the United States. A peer-reviewed study out of Cambridge University found they are the single largest shareholder in 88% of S&P 500 companies. Not a combined large shareholder, the largest. In nearly 9 out of 10 of America's biggest corporations. And this is personally what I think is the most underrated part of this whole story. They own all sides of the competition at the same time. BlackRock, Vanguard, and State Street collectively hold about 20% of Apple and 20% of Microsoft. They're top shareholders in all 4 major U.S. banks simultaneously. They own roughly 30% of Southwest Airlines and similar stakes in Delta, United, and American. Researchers at the University of Michigan found that this kind of common ownership in airlines was linked to ticket prices running 3 to 12% higher than they should be. If you're wondering how that's even legal, so is everyone else. But here's the detail that everyone missed at the time these firms got so big. Your 401k is the machine that feeds them. When your employer sets up a retirement plan, they hire a record keeper like Fidelity or Empower. That record keeper builds the fund menu, meaning the list of investments you're allowed to choose from. And fund companies, often controlled by the big 3, pay the record keeper to get their funds on that menu. The industry calls it revenue sharing. A Government Accountability Office investigation called it something closer to a kickback. Fund companies pay 5 to 125 basis points out of your fund's expense ratio back to the plan administrator. That money comes directly from your returns. And the GAO found that funds paying higher revenue sharing were significantly less likely to be removed from your plan, even when they performed terribly. Worst performing affiliated funds had a removal rate of just 13% versus 25% for outside funds. Your 401k menu isn't curated for your benefit, it's curated for theirs. And the timing of what happened next in the retirement industry? Almost too perfect. Target date funds became the default investment in most 401k plans. These are the ones named after the year you plan to retire, like Target 2030 or Target 2035. They now hold $4.8 trillion. The pitch is simple. Pick one fund and forget about it. What they don't explain clearly is that a target date fund is a fund that owns other funds. It's a wrapper. You pay the management fee on the target date fund plus the weighted average fees of every underlying fund inside it. Then add transaction costs that never appear on any statement. Cash drag from money sitting uninvested and soft dollar arrangements where fund managers route your trades through expensive brokers in exchange for research perks. A Forbes analysis estimated the real all-in cost of actively managed fund ownership at 3.5% in retirement accounts. The number printed on your statement might say 0.6%. The actual number eating your returns could be 5 or 6 times higher. I'll be honest, this is the part of the research that actually made me angry, because the gap between what people think they're paying and what they're actually paying is enormous. And it's by design. So what does this cost you in real dollars? The think tank demos calculated that a median income 2-earner household loses approximately $155,000 to 401k fees over a working lifetime. That's not a projection. That's nearly 1/3 of their total investment returns. Gone. The Department of Labor's own publication shows that a 1% annual fee difference on a $25,000 balance turns into a $64,000 gap over 35 years. On larger balances, the math gets sickening. A $500,000 nest egg paying 1% annually versus 0.03%? That one switch saves about $4,800 a year. Over 20 years, that compounds to roughly $320,000. That's the kind of number that makes accountants cry. If you're finding this useful so far, hit subscribe. I cover retirement finance traps like this every week, and the next one is even worse. While all of this was happening to individual retirement savers, a broader pattern was hiding in plain sight. I talk a lot about invisible monopolies on this channel. Briggs & Stratton quietly making the engine inside almost every residential mower, regardless of what brand name is on the housing. Luxottica owning Ray-Ban, Oakley, LensCrafters, Sunglass Hut, and the vision insurance you use to buy from their stores, all without anyone connecting the dots. The ABCD grain cartel controlling 70 to 90% of global grain trade while their profits tripled during the food price crisis. And who are their major shareholders? BlackRock, Vanguard, and State Street. The same three firms. Same playbook, different aisle. You'd think somebody in Washington would have fixed this by now. 4 separate times over 16 years, the Department of Labor tried to pass a fiduciary rule that would force retirement advisors to act in your best interest instead of their own. 4 times the rule was blocked, weakened, or vacated by courts. BlackRock alone spent $2.84 million on federal lobbying in 2024 and $2.57 million in 2025. Their PAC distributed $672,000 to federal candidates. And the revolving door spins both ways. BlackRock's former global head of sustainable investing became the director of Biden's National Economic Council. A former senior advisor to BlackRock's CEO became the deputy Treasury Secretary. During the 2020 market crash, the Federal Reserve handed BlackRock a no-bid contract to manage $750 billion in emergency bond purchases. And no, I'm not making that up. FOIA emails showed BlackRock's CEO, Larry Fink, was in near constant contact with the Treasury Secretary and the Fed chair while his firm managed the bailout. The people writing the rules and the people profiting from the rules keep trading desks. So what can you actually do? 3 things, and none of them require a financial advisor. First, go to Empower's free personal dashboard and link your retirement accounts. Their fee analyzer calculates your real weighted expense ratio and shows you the projected lifetime dollar cost. Second, if you've left a job or you're over 59 and a half, execute a direct rollover to a self-directed IRA at Fidelity, Schwab, or Vanguard. Direct, not indirect. Indirect triggers a 20% tax withholding. Inside that IRA, move into funds like Fidelity's Zero Total Market Index at literally 0% expense ratio, or Vanguard's Total Stock Market ETF at 0.03%. Compare that to the 0.6 to 1% you're probably paying now. Third, if you're stuck in a bad employer plan, bring fee benchmarks from FINRA's Fund Analyzer to your HR department and remind them they have a fiduciary duty under ERISA. With 74 excessive fee lawsuits filed in 2025 alone, employers are listening. Remember that target date fund that's supposed to be taking care of everything for you? It's working exactly as intended, just not for you. YouTube thinks you'll like this video, so click it. And if you made it to the end, subscribe.